Yesterday, we discussed sequence of returns risk and how market corrections in the early peri-retirement period may adversely affect your income in retirement. Portfolio protection against sequence of returns risk may involve holding buffer assets. You can think of buffer assets as very low-risk assets that exist in the space between liquid cash and equities. These are largely uncorrelated with your investment portfolio and serve as a buffer between the vicissitudes of the market and your spending needs or desires. Buffer assets are generally not subject to significant returns nor losses. During retirement, buffer assets provide immunization or protection, if you prefer, for your portfolio against selling equities at a loss to pay living expenses. Examples of buffer assets include the cash value of a whole life insurance policy or an indexed universal life insurance policy, or IUL. IUL insurance policies can assign cash value to track an index such as the S&P 500. As the index gains in value, your cash value is credited. Your money's not directly invested, so if the market experiences a correction, you're protected by a 0% floor, so you don't experience a loss of value. It's possible to design whole life and IUL insurance policies in different ways. Some policies may be designed with focus on a specific death benefit. Other objectives may include maximum cash value growth and accumulation. This is typically the design used for policies serving as a buffer asset. When structured and funded to serve as a buffer asset, you can access cash in an IUL on an annual basis at a safe withdrawal rate of about 6 to 8%. An interesting segment that has grown enormously since 2020 is buffer exchange traded funds. These use options to limit portfolio gains and losses. The down market of 2022, in which stocks and bonds dropped in tandem, saw significant growth and uptake of these products. Many investors were surprised when their bond portfolios dropped considerably, when their equity portfolio may have also dropped 20 or more percentage points that year. Buffer ETFs could be an option for extremely risk-averse investors or those with a very short time horizon for their investments. For most investors, there are better alternatives to adjust a portfolio's risk. Buffer ETFs have a narrow use case and tend to have high fees, 0.5 to 0.95% when compared to popular ETFs that don't cap upside growth and limit losses. If you recall our past discussions regarding ETFs, mutual funds, and the fees charged in these, buffer ETFs fall under the actively managed umbrella. Passive funds typically have lower fees than actively managed funds. Another buffer asset example is a home equity line of credit. If you would like to see an IUL or a combination of an IUL and HELOC designed to serve as buffer assets in your portfolio, call or text us at 205-725-0250.